Hello YouTube, welcome back to my channel. Welcome back traders. So this is day 2 on the boot camp and we'll be talking about Fibonacci. Okay, so let's get right into the video. All right, so what's the use of Fibonacci? As you can see on my screen, I have a Fibonacci drawn very clearly on my screen. So some of us know what Fibonacci is and the use of Fibonacci in trading, how it's used in calculating retracement. I mean the use of Fibonacci retracement to rather how it's in calculating retracement, why some of us do not know. So I'm going to run through the importance or the use of Fibonacci first of all. And before that, I'm going to like you to copy the settings of my Fibonacci so that you can have your own settings like mine. So here we go. These are my settings. Do a screenshot and then do another screenshot. I just slide it down. Okay. So let's get straight. The use of Fibonacci is very important in trading because it helps us measure every retracement. So our last video on day 1 of our boot camp, was showing us that we had 3 different market structure. We had the uptrend and we had the range that's going sideways that has no direction, and also we had the downtrend. Okay, so the nature of the market is that it moves in waves. The market moves in waves, and if the market moves in waves, there always has to be 2 different swings on every structure. What am I saying? 2 different swings is the real swing that shows the real direction of the market. This, the counter trend, also known as retracement. The real swing, also known as impulse, happens. So I'm saying impulse, retracement, impulse, retracement, impulse, retracement. The impulse are always longer, always more precise, always more aggressive, because this is generally an uptrend market. So because it's an uptrend market, any swing that points up goes higher, faster, and more precise. The retracements are always slower, or then it goes back up. So since the market moves in waves like this, the question is, if you were to trade this market, everybody knows the trend is your friend. In an uptrend, buy. In a downtrend, sell. So if you are going to buy this market, the best points to get involved in buying this market, these are the best points here. You get involved in buying this. These are the best points to buy because you want to catch the real swing. You don't want to trade wrongly in the retracement. You want to catch when the swing, when the buy momentum is coming in. That's what you want to buy. That's what you want to buy. That's what you want to buy when the buy momentum is starting. So the question is, if you're supposed to buy in all these points, how do you know when this retracement is over? Because in real life market, sometimes it retraces like this, sometimes it retraces like this, sometimes it retraces like this. So when should you buy? When is the right time to take a buy? This is just a representation of of um of the market structure in a very easy format, simplest form. In the real market, everything is more trickish and choppy. So the question is, how do you know when to buy at these levels? Because now it's showing that it has already happened. In the case where you haven't seen this, for instance, okay, you haven't seen this, for instance, price is still here. You don't know if it's going to go down. You don't know if it's going to go up immediately. If you don't know if it's going to It's not going to get to this circle. Maybe from here, it's going to go up. So that's supposed to be the question you all need to ask. When are we going to be comfortable buying? So now, this is where Fibonacci retracement comes in. So when price move like this, the first impulse, and it's retracing back down, this is where you draw your Fibonacci from the low of the impulse to the high. And when you do that, you want to buy when price has been able to retrace at least below the 50% level. So if you look at my Fibonacci very well, you find out that the anchor is strange, meaning I remove the lines for the anchor. Here, you just see a dot, and here, you just see a dot. Okay? Normally, they are supposed to be lines, but I removed it because I'm trying to make my chart as clean as possible. So if you took my settings, your Fib is going to look like mine. I care about the red line, which is 0.5%, and all these black lines. That's what I care about. But I care about this, especially the red line. So that's what I want to see, basically. So most price action traders have their Fibonacci levels like 50, 61.8. Remember, 61.8 is approximately 62. So my Fibonacci is different a little. This is, instead of 50 is 0.5. Instead of 61.8 is 0.62. Instead of 70.5, this is 0.705. Instead of 79.0, this is 0.79. So it's still the same thing, but it's just a little different. But the half of the Fibonacci 0.5, which is the 50 level, remains the half. Okay, so if price is able to come back, we trace back into this, we look to buy, because anything from here, the price is ready to go up. It will go down a little and start going back up, or it will go, but it should be at least after this red line has been tapped before we are ready to see a new high created. Okay, so once, how to use the Fibonacci, once a high is being broken, you cannot draw the same, you cannot use the same Fibonacci arrangement to determine the next retracement. Okay, so once a high is being broken, the next retracement is going to need you to redraw your Fibonacci. So I'm going to erase this. And I'm going to draw it again from here to the top. A new drawing, because it's a new swing. Okay, this first swing has been completed. Since it has broken this high, we have to draw a new one from this low to this high. Okay, from this low to this high. And when it comes to the red line, we're looking for buys again, or below the red line. Now, why is this so? This is so because smart money always want to buy low and sell high. Now, what do I mean by buying low and sell high? So I'm going to mark this as a range, this low and this high. What they do is they find the equilibrium in this range, meaning exactly half of the range. And to find the equilibrium, which is half of the range, you have to use a Fibonacci and mark out 50% of it. This is how you get an accurate half of the range. So this is 50% Fibonacci, and I kept the line on it. So they believe, or it's not they believe, this is what they do every single day. This is called a premium and below is called the discount. All right, I'm going to encourage this font a little. All right, so premium, discount. What do they mean by premium? What do they mean by discount? Now, in our everyday life economics, if I want to do a shoe business, I must buy the shoe at a cheaper price and sell it more expensive. This idea of discount and premium. I must buy the shoe at a discount price. Let's say $1,000, and when I want to sell the shoe, I sell it at $2,000. That's a premium price. So it means you must sell at premium and you must buy at discount for you to make profit in your business. It's the same here in forex, meaning whenever price is above the 50%, it's in premium. So smart money guys, not we are smart money concept traders, SMC. Smart money are the market makers. So what do? They sell once it's here and it's not um up to the 50% Fibonacci. Their orders move the market. So if they sell this because of them, because of the large orders, the price starts dropping. So because they're in the premium zone, they'll sell their way down here. And then when they get to the discount zone, they take off their buys straight from here. Are you seeing? So that is the reason why you see the trend moves in waves. Impulse, retracement, because they are working with premium and discount levels. Okay. So is this the same for a downtrend? Absolutely the same. So let me do the same thing for a downtrend market. Okay, so for a downtrend market, if price is doing this, so this is the first leg of the move, and this is the retracement, and this is the result. The first leg of the move is the impulse, whereby the downtrend. This is what is facing down. This is a minor retracement or a counter trend. This is another main move. So if I want to calculate where should I sell from, if I draw my fib from that high to this low, remember, if you're drawing your fib on a downtrend, you have to draw it in this direction. Look at this arrow. You have to draw it down from up to down. Why? Because it's a downtrend. So you pin your fib from up, draw it down. If it's an uptrend, you draw it from bottom to top. I get it. Why? Let it be able to show in this up direction. You know what I mean? Good. So up direction for uptrend fib or fib long, you must well call it, and down direction for downtrend fib or fib short, as you can call it. So the reason why price retraces up to the 50% of the Fibonacci or the range before dropping is because here is known as premium and here is known as well discount. So guess what? When this first starts, when this price first pulls back down, before the retracement happen, they see that price has pulled back into discount. So the what? Buy it back. Market makers will buy it back right up to this 50% or slight or above. Just making sure it enters the premium area. And then remember, you must sell at the premium. Then they sell. Markets are dumping again. Now they repeat the same process. Now it has broken this low. Remember, whenever price breaks a low, the old Fibonacci becomes useless. You have to draw a new one. Okay, so I'm drawing my new Fibonacci to calculate the next retracement. I want to get into this sales. I can't sell here. I can't sell while it's moving. I must sell when it has retraced so I can catch a new impulse move, just like how I sold here and caught the new impulse move, right? So if I draw my fib from top here, say I pin it to this level, my range has changed because this is now the high and this is now the new low and this is now half of the range. Everything has changed. So in as much as we are sitting at the moment in discount, smart money will have to buy this up to this level so I can get a premium. Remember, you must buy in discount, buy low, sell high. Buy in discount, when it gets to premium, they short it. It keeps going down. This is how an ideal downtrend occurs in the market. So let's go forward into the live charts and let me show you how this works for a downtrend and uptrend. Now we see a clean downtrend scenario, as you can see on GBP USD 15 minutes time frame. Okay, so this trend started here, and when it broke these lows like this, it broke this too. Okay, when it broke these lows, if you are going to get involved selling this, you're going to sell it from here. You're going to draw your fib. Now, if you're drawing your fib, you don't have to include the wicks of your fib. You just have to draw it from the body right here of the candles. So the body here. So if you see in this scenario, you see price retraced, but not up to the red line, but it dumped. It happens sometimes, but not all the time. But most of the time, it retraces back at least to the red line before dropping. So if you are going to trade this, you are already going to miss the move. Okay, you're already going to miss this whole sell drop. But then you're going to wait for another time when the trend has a breakout structure, just like this. It broke this low again, and allow opportunity to draw your fib. So I'm canceling the first fib because it's not irrelevant because we broke a low, and I'm going to try here from this high to this low. And this is a perfect example of what I meant. So you can see the high here and the low here. Remember, from the body down to the body. You see how price retraced nicely into the red line and slightly above, left rejection started falling. This was the area to short. All of this area was where you could sell. And you see how it dropped massively. Okay. I'm going to show you an example again for a downtrend market. So here again, price was still going down. Where did we break structure? This was broken. Structure was broken here. Okay. When structure was broken there, we needed a retracement so we can short. So you draw your fib from the top here to the bottom. Where's the bottom? Remember, this is the bottom. This is the top. This is the bottom. And did you see retracement? Yes, price retraced to the red line. Enough opportunity before you could what? Short. That's the second example for a downtrend. The third example rather. So what about an uptrend? Price has been bearish for this long, but when price flipped bullish was when there was a change of character around here. So this was a change of character. Change of character meaning price was able to shift or flip from bearish to bullish. Why? Instead of this to go, this was supposed to keep going down to clear this low to continue the bearish move, but it refused. Went to create a high, created a low, and broke the high. This shows that price has been able to flip bullish. So if price has been able to flip bullish this way, we have to be able to draw our fib in a bullish way to catch the retracement and catch a big move. So how do you draw fib long? From the low to the high. Okay, and guess what? This is the retracement. It went to the red line and even below left rejections here. This is enough opportunity for you to accumulate your buys, and you see price flew up. So let's get to another example for the buys for bulls, right? This is an uptrend scenario again, where price is breaking highs, going up, and price just broke this high. A new opportunity to draw fib, to know when to get involved in longs. So from this low to this high, from the low to the high, this I draw my fib, and you see the retracement back to the red line and even below, and you see where you have accumulated your long, and you see how price went up. Okay, this is how it works. So this is all about Fibonacci for now. So look forward to seeing you watch next video. Okay, so make sure you follow up this bootcamp, like this video, and subscribe to the channel if you really found this helpful. Peace out, guys.